Internal rate of return, IRR. Concept and calculation process. The internal rate of return, IRR, represents the discount rate at which a project's net present value equals zero. In other words, it is the rate of return that equates the present value of inflows with the initial investment. The calculation involves trial and error or interpolation between two discount rates, though modern software automates the process. Mathematically, it satisfies sigma, cash inflows divided by 1 plus R, initial outlay equals 0. IRR expresses project performance as a percentage, facilitating comparison with the company's cost of capital or required rate of return. A project is acceptable if its IRR exceeds the hurdle rate, indicating that it generates returns above capital cost. Strengths and advantages. IRR's primary advantage is its intuitive interpretation as a percentage return, aligning easily with management expectations and investor benchmarks. Unlike ARR, IRR uses cash flows rather than accounting profits and incorporates the time value of money. This makes it a dynamic measure of project efficiency, highlighting how much value each investment generates relative to cost. IRR is especially effective in comparing projects of similar scale or risk. It provides a clear decision rule: accept projects where IRR exceeds the cost of capital. Additionally, IRR captures both magnitude and timing of cash flows, making it superior to simpler methods like payback or ARR. Weaknesses and limitations. Despite its strengths, IRR has notable limitations. For non-conventional cash flows, with multiple sign changes, projects may produce multiple or no IRRs, complicating interpretation. IRR also assumes that interim cash inflows are reinvested at the same rate as the IRR itself, which may be unrealistic. It can rank mutually exclusive projects incorrectly when differences in size, timing, or duration exist. For example, a smaller project may have a higher IRR but lower absolute NPV. Therefore, IRR should not be used in isolation. Managers must interpret it alongside NPV for consistency. Moreover, IRR's iterative nature makes manual calculation time-consuming without computational tools. Appropriate usage. IRR is most suitable for evaluating independent projects with conventional cash flows, where reinvestment assumptions are plausible. It serves well in performance benchmarking, comparing potential returns to the firm's weighted average cost of capital, WACC. Modified IRR, MIR, addresses reinvestment concerns by assuming reinvestment at the firm's cost of capital, providing a more realistic measure of profitability. IRR is also valuable in communicating investment attractiveness to non-financial audiences, as its percentage format simplifies understanding compared to NPV's absolute figures. Comparison with other methods. While NPV focuses on absolute value creation, IRR presents relative efficiency. In cases of capital rationing, NPV should take precedence, as it measures total wealth generated. However, IRR's percentage output makes it a useful secondary measure, aiding prioritization where hurdle rates define acceptance thresholds. Compared to payback and ARR, IRR better reflects the economic value of time, aligning more closely with shareholder wealth maximization. Nonetheless, it can mislead when projects differ significantly in scale or risk, reinforcing the need for integrated evaluation. Role in prioritization. In project prioritization, IRR supports ranking by rate of return relative to cost of capital. Projects with higher IRRs are preferred if they exceed required thresholds. When capital rationing applies, combining IRR with NPV ensures that both relative efficiency and total contribution to value are considered. However, decision-makers must avoid relying solely on IRR for mutually exclusive projects where scale disparities distort rankings. In practice, firms often integrate IRR within portfolio analysis frameworks to balance profitability, liquidity, and strategic alignment, ensuring optimal allocation of capital resources.